While you were sleeping, the rules of global wealth were rewritten by a silent stroke of a pen. At exactly 2 a.m. Swiss time, a physical wall was erected around the world's most critical industrial metal. There were no flashing sirens on Wall Street, no emergency broadcasts on major news networks, and no frantic tweets from the Federal Reserve. Just a quiet, surgical strike on the global supply chain that has effectively ended the era of cheap, available silver forever. Switzerland, the undisputed heart of the world's precious metals refining, has pulled the emergency brake. They aren't just freezing bank accounts, they are freezing the physical atoms of silver that keep your smartphone running, your electric vehicle charging, and the Pentagon's missile systems on target. Here is the paradox. Look at your screen right now. The paper price of silver, the neat little ticker flickering on the COMEX, suggests a world of calm, but that price is a ghost. In the real world, in the high-stakes backrooms of Tokyo, Shanghai, and Dubai, physical silver is already trading at premiums that would make your head spin. We are witnessing a systemic liquidity squeeze that the public isn't supposed to see. This is the rare earth's moment for the West. China has slammed the door, Switzerland has locked the gate, and the United States has just realized it is trapped, outside in the cold. Today, we perform a forensic analysis of the 2 a.m. freeze to reveal why the smart money is vanishing into the shadows, and why the paper market is about to suffer a violent, terminal heart attack. To understand the chaos, we must look at the crime scene. On January 1, 2026, China, the dragon that produces and refines a massive portion of the world's silver, officially reclassified silver as a national strategic material. In bureaucratic language, that is a kill switch. They didn't ban it, they licensed it, ensuring that only state-approved entities could move an ounce out of the country. But the real earthquake hit the Alps, the three titans of the refining world, PAMP, Valcambi, and Argor-Heraeus, who together process roughly 70% of the world's refined silver, received a chilling notice from the Swiss Federal Customs Administration, effective immediately. All silver shipments over 1,000 kilograms are subject to a mandatory export license review. The minimum processing time, 14 to 21 business days. In the high-speed world of global logistics, 21 days is an eternity. It is, for all intents and purposes, a total freeze. Every major commercial shipment of silver is now hitting a bureaucratic wall. Bars destined for the U.S. Mint, granules headed to German solar factories, and kilobars promised to Asian investors are all sitting in Swiss warehouses, gathering dust. This isn't just a delay. It is triage. Switzerland produces zero silver of its own. It is a pass-through node that relies on raw material from China, Peru, and Mexico. With China cutting the cord, the Swiss vaults began to bleed out. Reports from insiders suggest combined inventories at the major refineries dropped to a staggering 8 million ounces, less than a single week of global industrial demand. Faced with a choice between serving the global market or saving their own domestic industry, the Swiss chose self-preservation. The valve is closed. Now, let's peel back the layers and look at the hidden war driving this collapse. Why now, and why silver? The paper illusion versus the physical reality. For decades, the global financial elite have used paper silver to suppress the true value of the metal. For every 1 physical ounce of silver sitting in a vault, there are hundreds of paper claims, ETFs, futures, and unallocated accounts. It's a giant game of musical chairs. As long as no one asks for their chair, the music keeps playing. But Switzerland just stopped the music. When you freeze the physical metal, the paper claims become worthless. We are seeing a structural fracture where the screen price and the street price are decoupling. If you can't take delivery of the metal, the price on your phone is just a meaningless number. The smart money knows this. They bypasses the exchanges and outbid everyone to secure what little physical inventory is left. The U.S.-China economic war. Weaponizing the periodic table. China's export ban isn't a random policy. It's a strategic masterstroke in the ongoing war with the United States. Silver is the Achilles heel of the modern tech economy. The net zero trap. You cannot build a green revolution without silver. Every solar panel requires silver paste. Every electric vehicle requires twice the silver of an internal combustion car. By controlling the silver supply, Beijing effectively controls the speed of the West's energy transition. The military dimension. Silver is essential for high-end electronics and guided munitions and satellite tech. The U.S. defense industrial base is now staring at a supply chain that runs directly through their greatest rival, the corporate bloodbath behind the scenes. The giants are panicking. Imagine a German solar manufacturer that signed a long-term contract to buy silver at $80 an ounce back when it was $25. Now the physical price is $150. The Swiss refineries are staring at billions in losses if they honor those contracts. If they don't, the manufacturers go dark. This is why the German government is reportedly calling Bern in a state of desperation. We are seeing a scramble for scarcity where corporations are now acting like sovereign nations, trying to bypass traditional markets to secure raw materials. The just-in-time inventory model has been replaced by just-in-case survival, the net-zero paradox. The irony is biting. The very governments pushing for a net-zero future have failed to secure the one metal required to achieve it. The demand from the solar industry alone is projected to consume 85% of global silver production by 2030. There is no plan B. There is no substitute for silver's conductivity. The math doesn't work, and the market is finally realizing it. Switzerland's 2 a.m. decision was the death knell for the old globalized system of trust. When the world's most reliable, neutral, and efficient refining hub decides to hoard its output for national security, it tells you that the system is broken beyond repair. The information asymmetry window is closing right now. The financial media is still treating this as a temporary procedural delay. But you don't use emergency national security language for a simple paperwork update. The refineries are running, but the silver isn't leaving. It's staying home to feed Swiss industries and fill the strategic reserves of the Swiss National Bank. So, what are the consequences? First, the era of low premiums is over. Paying 50% or 100% over the paper price is no longer an anomaly. It's the entry fee for the only market that matters. Second, the paper market faces a looming force majeure. At some point, the COMEX will have to admit they cannot deliver the physical metal at the paper price. When that happens, the price won't just rise, it will gap up to levels that seem impossible today. The 2 a.m. freeze was the starting gun for a race that most people don't even know they're in. The people who understand what is happening are moving in silence. They are locking in alternative supplies, securing physical custody, and preparing for a world where availability is more important than price. In the world of investigative finance, being early often feels like being wrong. Right up until the moment everyone else realizes they are too late. Switzerland just showed the world its hand. China just flipped the table. The question is, when the paper illusion finally evaporates, what will you actually own? The countdown didn't start today. It started at 2 a.m. Swiss time. The valve is closed, the music has stopped, and there are no chairs left.
Reuters has just released its latest macroeconomic report titled "Gold Prices Slip Lower as U.S. Inflation Figures Firmer, Dollar Rises." On the surface, the market appears to be reacting strictly according to the textbook. When the U.S. dollar index, DXY, strengthens, algorithmic trading models automatically trigger sell orders for precious metals. The investing crowd is currently focusing their attention on gold, assuming the upward trend has stalled due to the hawkish macro environment. However, if we look deeper into capital flow data and the underlying market structure, a massive anomaly is currently unfolding in silver, one that retail investors are largely missing. While short-term price charts indicate selling pressure driven by high-frequency trading algorithms, the actions of smart money in institutional accumulators are telling a completely different story. This is not a sell-off to exit positions. Quantitative data suggests this is a classic liquidity shakeout. We are witnessing a sharp divergence between the paper price, futures contracts, and the physical price, real metal. While the paper price dips, physical premiums are rising. This mechanism is designed to flush out weak hands and leveraged speculators, allowing institutional players to acquire positions at a discount before the market establishes a new price floor based on actual, undeniable physical supply scarcity. Let's dive into a forensic analysis of the market data to understand the gravity of the situation. In October 2025, China made an unprecedented move, exporting 660 tons of silver in a single month. To put this in perspective, this volume exceeds their typical annual export quota and runs completely counter to the strict strategic resource controls Beijing implemented earlier this year to protect supply for its domestic solar manufacturing base. According to basic economic laws of supply and demand, when such a massive supply shock hits the global market, asset prices should drop sharply due to the sudden surplus. But what is the reality? Silver prices not only didn't crash, but they also continued to break historical highs, surpassing $66 per ounce this December. Why this paradox? The answer lies in the rapid depletion of the Shanghai Futures Exchange's stockpiles. Data shows that silver inventory in Shanghai has collapsed from a peak of 3,911 tons in January 2021. Only about 780 tons remain today. Effectively, they have burned through nearly 80% of their strategic reserves in less than 5 years. The export of those 660 tons was not a commercial sale of surplus inventory. It was an emergency liquidity injection for the London Bullion Association. The London market is currently facing severe backwardation, a condition where current prices are higher than future prices, signaling a physical squeeze. China was forced to act as the supplier of last resort to arbitrage the price difference and prevent a breakdown of the global pricing mechanism. So where did that massive amount of silver go? It didn't stay in London vaults. Import data reveals a massive shift of physical capital towards India. In just September and October alone, India imported a staggering 2,600 tons of silver. The metal flows are moving from Chinese reserves through London and Hong Kong intermediaries and are being completely absorbed by India. This is not just jewelry demand. It is a strategic accumulation by Indian industrial conglomerates preparing for their own green energy transition. This leads us to the bigger picture regarding fundamentals, which are currently stronger than at any point in the last 50 years. The year 2025 marks a collision between two opposing forces: inelastic demand versus finite supply. On the demand side, we are seeing inelastic industrial demand. The global transition to net zero relies heavily on silver. Solar. The latest TOPCON and HJT solar cell technologies require 20 to 50% more silver per panel than previous generations. This is a classic example of Jevons paradox. As solar technology becomes more efficient and cheaper, total adoption skyrockets, driving aggregate silver consumption higher, not lower. AI and tech. As we build out massive AI data centers, the need for high-performance connectors and switches is exploding. Silver has the highest electrical conductivity of any element. It has no substitute in these high-efficiency applications. Manufacturers are forced to buy silver, regardless of the price, whether it is $30 or $100, to keep multi-billion-dollar production lines running. Crucially, we must also consider the geopolitical risk premium. Silver is transitioning from a monetary asset to a strategic national security asset. Major producing nations like Mexico and Peru are increasingly discussing resource nationalism policies. If these governments decide to increase royalties or nationalize mines to capture more revenue, the global supply chain faces an immediate shock. We are moving away from a globalized free trade market for minerals to a fragmented protectionist environment. On the supply side, the situation is critical. We are facing a structural deficit. Mining output is flat or declining due to years of capex starvation and falling ore grades. Furthermore, 70% of silver is mined as a byproduct of zinc, lead, and copper. Even if silver prices double, copper mines will not ramp up production just to get a little more silver. This supply inelasticity means the market simply cannot respond quickly to the demand shock. So, what is the scenario for the near future? At the current burn rate, the visible inventory in Shanghai is sufficient for only about 2 more weeks of trading. When this buffer disappears, the market enters uncharted territory. We anticipate a decoupling event. This occurs when the paper market, futures, derivatives, and the physical market break their correlation. Currently, the paper market operates on massive leverage known as rehypothecation. It is estimated that for every ounce of physical silver in the vaults, there are potentially hundreds of paper ounces traded. As long as investors are happy settling in cash, the game continues. But when industrial buyers, who need the metal for production, start demanding physical delivery that the COMEX or LBMA vaults cannot meet, the system breaks. Exchanges may declare force majeure and force cash settlements. This is the ultimate short squeeze. Short sellers will be forced to cover their positions at any price, pushing the price chart vertically to find a new equilibrium where demand is finally destroyed, a price likely much higher than today's levels. My strategic advice for investors is as follows. Do not let short-term volatility based on CPI prints or Fed speeches distract you from the geological reality. We are looking at a mathematical certainty of depletion at current prices. Institutional allocation to silver is currently less than 0.5% of global assets. If that allocation merely shifts to 1%, the buying pressure would be overwhelming. Silver is currently in the most attractive valuation zone relative to its growth potential. The gold-silver ratio is currently hovering near historical extremes. If this ratio reverts to its historical mean of roughly 60-1, or the geological ratio of 15-1, the upside potential for silver presents a highly asymmetrical risk-reward profile. This is a phase of wealth transfer. It is a transfer from those holding depreciating currency and unbacked paper contracts to those holding essential, finite, real assets. Ensure you are on the right side of this transfer.
There has been an unwritten rule on Wall Street for the past 40 years. Silence on a Friday evening usually signifies settlement. Positions have been closed, risks have been hedged, and the bankers have left their offices to enjoy the weekend. But this weekend, that silence carries a completely different tone. It is the calm before a Category 5 storm. Last Friday, we witnessed a technical black swan event. According to the standard script, silver prices are always subjected to automated selling pressure during the final session of the week to crush the momentum of the bulls. But this time, that script was torn to shreds. Instead of collapsing, the market accelerated and closed at the absolute highs of the week, $67.14. Let that number sink into your trading psychology, $67.14. For the retail investor, this is good news, but for the risk management departments at the major bullion banks, this is a liquidity disaster. They are currently trapped with billions of dollars in net short positions that are deeply underwater while the market is closed. They are locked in a panic room with no exit for 48 hours. In today's deep dive report, we are going to dissect this event. We will analyze why this closing price is not just a number, but the fuse that will trigger a massive chain of margin calls come Monday morning. To understand the severity of this, we need to look at the market microstructure. When a market closes at the highs of the week, it sends an incredibly powerful signal. The buyers accepted market orders at any price, right down to the final seconds. This indicates that smart money currently fears the risk of not owning the asset more than they fear the price risk itself. Put yourself in the shoes of a market maker who is short silver in the $64 region. Their quantitative models predicted a drop to $60 so they could cover and take profit. But reality forced the price to $67.14. Their unrealized loss is currently sitting at over $3 per ounce on a volume of millions of ounces. But we must also address the elephant in the room, the options market and gamma exposure. At $67.14, we have pushed deep in the money, ITM, for a vast array of call options that were previously written off as worthless. This forces options dealers into a gamma squeeze. As the price rises, dealers, who must remain market neutral, are mathematically forced to buy more of the underlying futures to hedge their exposure. It becomes a feedback loop from hell for the shorts. They aren't just fighting the trend, they are fighting the mathematics of the derivatives market itself. Furthermore, we must anticipate the reaction of high-frequency trading algorithms. These black boxes thrive on momentum ignition. A gap opening above $67.14 will trigger automated buy programs before a single human trader has had their morning coffee. These algorithms do not care about valuation, they only care about velocity. They will pour fuel on the fire, exacerbating the move in milliseconds. And here is the fatal issue: variation margin. Typically, these losses are settled in cash at the end of the day, but Friday's price shock was too massive and too fast. It blew through the credit lines of many hedge funds. On Saturday morning, while the market was closed, margin calls were sent out. The demand is simple: post additional collateral before the Asian Open on Monday or face forced liquidation. And when a short fund faces forced liquidation, the computer system executes only one command: buy back at any price to close the position. This creates a classic short squeeze scenario. On Monday morning, we may not see buying power from natural demand, but buying power born from the panic of financial institutions trampling over each other to exit.
However, the financial story is just the tip of the iceberg. The submerged part, and the most dangerous part, lies in the dislocation between the paper market and the physical market. We are witnessing a record-breaking arbitrage spread. In New York, COMEX, silver is at $67.14, but in Shanghai, SGE, silver is trading around the $72 mark. A $5 spread in the commodities market is a massive figure. It creates a vacuum effect. Any silver bar that can be moved is being packed and shipped from London and New York to China. The West is suffering a physical liquidity drain. Why? Because industrial giants like Samsung or Tesla cannot operate production lines using futures contracts. They need real metal. They are executing off-market deals, securing supply directly from the mines, bypassing the COMEX entirely. Furthermore, we are hearing reports of a quiet run on the bank regarding unallocated accounts. For years, banks have sold paper claims on silver they do not fully possess, a fractional reserve system. But now, high-net-worth clients and family offices are demanding conversion to allocated status. They are asking for the serial numbers. They want the bars moved to a segregated shelf. This forces the banks to show their hand. If they don't have the metal, they must go into the open market and buy it immediately to satisfy the client and prevent a default event. This internal squeeze is invisible to the public, but it is the primary driver of the desperation we are seeing. The consequence? The spot price on your screen is slowly becoming a virtual reference. It no longer reflects the true cost to possess the physical metal. Registered inventory, metal that meets delivery standards, is depleting at an alarming rate. We are approaching 0 hour. When the Asian markets open, the most probable scenario is a gap up. The price could open directly at $68.50 or $69, skipping the intermediate levels entirely. However, as professional investors, we must keep a cool head. Extreme volatility always comes with risk. Here is the battle plan for the upcoming session: patience in the face of a gap up. If the market opens with a massive gap to the upside, do not FOMO. In theory, the price often tends to return to fill the gap, to test demand. Watch the support zone at $67. Beware the shakeout. Understand that the institutions know the retail psychology. They may engineer a sharp, violent drop, a rug pull in the early hours to trigger stop losses and flush out weak hands. Do not mistake a liquidity flush for a trend reversal. Monitor the psychological level of $70. This is not just a round number, it is the last bastion of the bears. If the price decisively breaks $70, the technical model shifts to a parabolic state, vertical appreciation into the price discovery zone. Focus on real assets. In an environment of elevated counterparty risk, holding physical positions is the optimal defensive measure.
In conclusion, Friday's closing price of $67.14 is not the destination. It is the siren signaling the collapse of the old price control algorithms. The bank's liquidity nightmare is becoming a historic opportunity for investors who are prepared. I will continue to update you on capital flow developments as soon as the session begins. Thank you for watching.